technology in focus. Among the big names reporting earnings today, Google's parent company, Alphabet. Less than a week after the company was hit with a record $5 billion fine by the EU. Our next guest says there's opportunity here. Joining me now is Alfred Esksandar, CEO of Salt Financial. Alfred, good to see you.
Good morning. Good to be here.
Good to see you. What are you expecting from Alphabet today?
Well, we're pretty excited about Google's earnings today, and we think
yeah, just call it Google. Yeah, that's fine.
we think it has shown a lot more life lately. It has gone from what we viewed as a very calm stock, only rising about 1.1% more than the S&P for the first few months, to now actually showing a whole lot more sensitivity. And what we really look for are stocks and sectors that are sensitive to the overall market, because we think that's where investors can get an edge.
Well, volatility, really, when we entered this year, it's just been a theme. It's been returned to the market, and I think a lot of individual investors have had a hard time dealing with that. But the good news about that is it's resulted in a decoupling of individual securities from the actual overall market. How do you take advantage of that, and is tech the biggest place that you can take advantage of it?
Well, tech has certainly been the big story all year. In fact, if you look at its performance, it's up around 15% year to date versus, 5% for the S&P. Mm-hmm. So, but if you're going to have a broader market rally, other sectors need to participate as well. Volatility, as you mentioned, has spiked up this year. Certainly, we all remember February. But if you look at last year, we all kind of fell asleep. Volatility was incredibly low. The market was tremendously resilient and just showed no sign of slowing down or going down. This year, volatility has returned a little bit more to normal. I believe the VIX is around 12, 13 right now. Normally, it's actually around 17, so we're still somewhat calm.
Where do you think is the greatest risk in terms of, even if you just want to look at industries that are overpriced, ripe for volatility? I was just looking at how these big tech stocks performed month to date, and Alphabet going into this earnings report is still up 6%. It's not up as much as, say, a Facebook, an Amazon, or even a Microsoft. Microsoft's up closer to 8%, but it's still got a really nice fat gain on it for the month.
Yeah. Well, it's interesting you mentioned Facebook. That's also going to report later on. Right. I believe it's on Wednesday.
And Amazon, too, later in the week.
But just focusing on Facebook for a second, the thing that's important for investors, particularly retail, there's only three ways to make money in the market: your selection, your timing, and your overall allocation. And Facebook has been a relatively calm stock, believe it or not. I mean, it had a little bit of an issue in February, March, I believe. It brushed it off, hit new highs, but it's not moving as much with the market. And that's what we look for in terms of giving an edge back to investors to basically participate more in the upward rally.
Alfred, if you want to sort of look beyond the big tech names who are clearly driving the S&P, where are the places in the S&P 500? What sectors would you sort of rotate to if you're just worried about how frothy some of those names have gotten?
So we love financials, industrials, as you guys mentioned earlier, and technology. Those are the three biggest sectors right now in our fund. We see these sectors, again, way more sensitive to the overall market than some of the others, and we think that's where you want to be exposed for this quarter. Ironically, energy was the big surprise second quarter. I don't think anyone really called it out, but it actually outpaced technology. It was a 14% surprise gainer versus 5%, I believe, for technology at the same time. So thinking about sectors, again, industrials, financials, and technology is where you want to be right now.
So you think energy's over, though? Because this is going to be a good quarter probably for the energy
11 million barrels a day. Energy
price is up 41% in the second quarter, so the number should be really good.
True, but then we saw some pressure on crude, and we saw the energy trade slip away. If we're going to get into a bounce, and if we're going to have a little bit more momentum in the second half of the year, we don't see energy right now as the place to be. The industrials, financials, and technology sectors right now are demonstrating to us the highest true beta score.
You mentioned industrials, but industrials would be and are the most vulnerable to this trade fight that we've gotten into, even our major trading partners, with the steel and aluminum tariffs initially, even the washing machine tariffs early in the year that kicked in January. Now we're in this fight, and so there is the greatest downside risk in industrials. I pointed out Caterpillar and 3M are down 13% and 14% respectively year to date. And we've got 3M, Harley-Davidson, and Whirlpool come out with earnings later this week.
Yeah, industrials are obviously much more sensitive to trade tariffs than some of the other sectors. When we look at tariffs at $32 billion, it's not a big piece of the overall economy. I think last week with the Trump administration talking about potentially $500 billion, that's a different ballgame. So it will be challenged.
Well, did the market react to that at all? Because again, it was kind of a so-so.
It flinched a little bit, and it didn't have a massive move. And I think for investors to take some comfort, the market's become incredibly efficient and resilient. And by that I mean, in my 20+ years of being in this business, I've seen the market become better and better and better in distilling information, not getting, actually being able to differentiate between sensationalism and substance. And I think we saw that last week.
Well, what about the sensationalism and/or substance of the president tweeting about the Federal Reserve and the U.S. dollar and other currencies? Because, again, Secretary Mnuchin came out and said, well, the president believes in an independent Federal Reserve. But in the past, when you have presidential pressure on the central bank, it down the road has created some serious problems for the country. And I'm talking about runaway inflation in the 70s.
Well, Chairman Powell, I think, did a great job with his testimony last week. And I think what he demonstrated was a clarity in how he sees things progressing. It's very hard to not be optimistic about the second half of the year, given how tremendous the job market looks right now. And if anything, I think he's doing the president a favor. By controlling inflation, you get to continue the growth that we're enjoying right now.
Well, maybe the president is. we'll see if the president is hearing that message, because the Wall Street Journal reported that he picked Jay Powell over Kevin Warsh and John Taylor because he was told that Jay Powell would be more malleable. So again, there is some expectation that there could be some executive branch control over the Fed, but we'll see what happens. Good to see you, Alfred.
Good
Alfred
to be here.
Esksandar. Thank you. And